There are not many things that I loathe more in this world than mortgage life insurance. In Canada, I think it is one of the biggest scams and biggest ripoffs that Canadians get into each and every single day without even knowing it. And so in this video, I'm going to explain exactly what mortgage life insurance is, how you can avoid it, how you can identify it, and by the end of this video, you'll know exactly what alternative you can use that is significantly better than it at a much cheaper rate. What's up, guys? For those of you who do not know me, my name is Philip Setter. I'm the founder and CEO of Affinity Life, which is an online life insurance platform here in Canada where you can view quotes 100% online and apply 100% online as well. So if that sounds interesting, I'll put the link in the description below and you can check it out. But without further ado, let's get right into the video. Okay, so you've just bought your first home. Congratulations. I'm incredibly proud of you. However, here's how it looks. You go in, you talk to your real estate agent, your broker, or whatever it is. You talk to your mortgage broker. You're having a good time. You're getting excited. You're going in. Did you qualify for the house? Yes, you qualified. Awesome. Okay, so when is our purchase date? When is our possession date? You go into the bank to sign the last final documents. And now this home that you've been looking at for the last 3 or 4 months is yours. You're incredibly excited. You walk into the bank to sign the documents. You go in and yes, I will take this mortgage, whatever it is. And then there's a little box and they say, hey, would you like to protect yourself? In the case you died, your mortgage will be paid off. It's super easy. All you got to do is fill out this little form. There's like 5 questions on it. It's incredibly easy. We'll just tack the premium onto your mortgage. You won't even notice it. You're paying $2, $3 grand, $4 grand anyways for your house. What's an extra $50 or $100 or $150? And you think, okay, that's not a bad idea. Why not? You check the little box, you sign the little signature, you're already overwhelmed by the amount of documents that they're putting in front of you, and you're just excited to get into your house. You'll sign whatever it is. Get me into the house. I want to put my furniture in it now. And so you sign it and you're on your way. Well, what did you just buy? What did you just sign up for? Let me explain it to you. So mortgage life insurance, which is totally different from mortgage insurance. Now, mortgage insurance from the CMHC, which is the Canadian Mortgage Housing Corporation, I believe, that is totally different. That is a type of insurance that you need to purchase here in Canada if you buy a property for less than 20% down. So if you just want to put 5% down or 10% down, you're legally obligated to buy this type of insurance, and it has nothing to do with your death and everything to do with if you default, the lender will receive their money back. That's the primary reason, is they're protecting their loan that they gave you. Because the house is so leveraged, they say, we want to make sure that this portion we're protected against. Totally different than mortgage life insurance. Mortgage life insurance is not issued by a life insurance company. It's not traditional life insurance. It's what's known as creditor insurance. Now, how this type of insurance works is it's issued from the lending institution. So it's from the bank. It's not from an insurance company. It's from a creditor institution. And what they've created is a very inferior product to traditional life insurance. And I'll explain a little bit how it works. So when you signed up for your mortgage, you had this quick little sheet that you quickly check the boxes of, and you signed it and you gave it to them. So how this works is they took that, and there was some medical questions on there, but essentially it's a very quick issue type of product. So they actually do not underwrite this product at the time of application. So what does that mean? And this is the biggest problem with mortgage life insurance, okay? What that means is you answer all those questions. They're not going to double check them until you die. That's the biggest problem. So it's what's known as post-claim underwritten. That means that maybe you didn't understand one of the questions. Maybe you just quickly read them as you were going through your mortgage application and everything else. Maybe you answered something in a hurry. You didn't understand it. You didn't read it fully. They're not going to double check any of that until you actually make a claim. And of course, you're not making the claim. You would have passed away in that part. So what does that mean? Well, that means that essentially you're banking on the fact that at the time you understood everything that you signed up for. You understood all the questions. You didn't answer them, any of them incorrectly. Because what happens is if you did pass away and your family went to go make a claim and there was some discrepancy on the application because maybe you didn't read the question fully or whatever be it, then they actually look at it at the time of claim when they say, okay, well, wait a second. He answered this, but maybe if we do a little bit of research, oh, it seems that, there was some discrepancy here. We're not going to pay the claim. We're not going to pay out the mortgage, and we'll return your premiums to you, which is kind of a slap in the face, but we're not going to pay out any of the claim. So you're really buying a product that you're not even 100% sure if it's going to pay out or not. It's a maybe that it'll pay out, hoping that you answered all the questions truthfully. This is the number one problem of mortgage life insurance. The number two problem is it's a shrinking benefit. So what do I mean by that? Well, when you buy your house, you have a mortgage of, let's say, $300,000 on that house. You're paying, let's say, $150 to $200 for this insurance, which isn't really insurance, of course. And every single month, you're paying down your house. So what does that mean? Well, maybe in 3 years or 5 years, you paid it down $30,000 or $50,000. Well, now they're only going to pay off what the remaining balance of your mortgage is, but you're not getting any deals on the premium. You're still paying the exact same every month for this product. So your benefit is shrinking every single month. You're paying more and more off, and you're getting less and less and less as you get older, but you're still paying the same. Which leads me to my third biggest problem with mortgage life insurance is every time you renew your term for your mortgage, you're going to have to reapply for a new policy, and you're going to, of course, be, 3 or 5 or 10 years old or whatever your term is. And now your premium for that product that you had is going to jump up again and again, which leads me to my fourth problem with mortgage life insurance. In 99% of applications of the time, this is a more expensive product than just a traditional term life insurance product. So not only are you paying more, but it's an inferior product. It's not even as good as traditional life insurance. So what is the alternative to this? Well, I would say a traditional term life insurance option from an insurance company is the best option. Here's the thing. With a traditional term life insurance option, you get to pick your beneficiaries. So you can pick essentially your spouse, you can pick other relatives, you could pick maybe your kids get something. You get to pick who the beneficiary is. With mortgage life insurance, it's the bank. They get the money. It doesn't go to your spouse at all. Of course, your spouse is in the house, so they would have the mortgage paid off. However, there's other expenses that are going to arise upon your death. If you did suddenly pass away above and beyond just your mortgage, of course, there's more bills that you pay for each and every month. And if your income were to vanish because you passed away, those bills would still need to be paid. So again, with traditional term life insurance, you can pick the beneficiary, you can pick the actual term that you need. So maybe not a term 5 or a term 10, which is what you would get with mortgage life insurance, but maybe a term 20 or a term 30 to actually cover the full length of the mortgage. And you can lock in those rates. They're not going to rise. It's a fixed rate for the duration of that term, and it's typically much cheaper than a mortgage life insurance product, like I mentioned. And again, if you wanted to find instant term life insurance rates, you can go to affinitylife.ca and check that out. But with all that being said, if you unfortunately purchase mortgage life insurance and you're wondering what it is, I would highly recommend canceling that product and getting a more traditional term life insurance product. And you're probably wondering, why are people even buying this in the first place? Well, I mean, banks just have an easy way to add another source of income to their bottom line. And if they can just offer this quick little issue mortgage life insurance, and it's just a little box that you fill out on your application, they already have you in the office at that point. So they might as well just try and push this product on you. So I think the reason that a lot of Canadians have this inferior product is they just don't understand actually how it works. And it's just quick and easy to purchase. But quick and easy doesn't always mean best. So if you have this, I would highly suggest replacing it with an actual traditional term life insurance product. And if you guys have any questions, feel free to drop them in the comments below and I will answer each and every single one of them. And if you guys are enjoying this content, all I ask is that you give it a thumbs up, and I'll see you guys in the next one.